Well, welcome and thanks for joining us. My name is Chris Baker and I'm the president of the Delaware County Foundation. Also joining me today is James Ross with the Mason Companies. And together we want to spend a little bit of time exploring the third quarter of 2020 and market performance. And I think it's safe to say that 2020 continues to keep us on our toes. And the first quarter we saw extreme volatility. The second quarter led to breaking growth. And in the third quarter, we seem to combine both the themes of volatility and growth, despite a 10% correction in domestic markets. So, James, share for us a little bit about what you've seen as drivers of performance in the third quarter.
Thanks, Chris. I appreciate it. You kind of hit the nail on the head. Very simply, in the third quarter, and to some degree as a pull through from the second quarter, what drove portfolios and markets up were the laggards from the first quarter. So the total portfolio return for the quarter was positive 5.25%, which is a fantastic quarter. Again, coming off of the heels of a record-breaking second quarter, it's very easy to forget that markets and the portfolio was down over 30% in the first quarter at one point in time on March 23rd. So quite a recovery to be positive year to date, and then obviously all the way through the third quarter positive numbers. Driving that return, small cap international stocks were up over 9%. US large cap was up over 8%. And then kind of interesting, almost inverted from the first quarter, what kind of was a drag on performance, cash up about 0.25%. Again, no surprise as equity markets run up. And then fixed income was up 1.3%. Not a terrible quarter for fixed income by any stretch, but considering how well equity markets performed, a little bit of a lag there. And really similar themes that we saw in second quarter as well, just to a lesser degree into third quarter. So a complete inversion from Q1.
Excellent. Well, thanks for that. Certainly one of the challenges facing our community right now is high unemployment. We see the impacts, frankly, every day through the work of the foundation in funding our partners. We have seen large increases, since the beginning of the year in individuals seeking basic need assistance, everything from food, utility, and housing. So unemployment continues to be a bit of a challenge for us here in Delaware County. Despite dropping from a record high, how has unemployment impacted third quarter performance?
Well, what we're starting to see, unemployment really improved dramatically in Q2, but what we're starting to see in Q3 is really a little bit of a separation between industries that are picking up steam versus those that are continuing to lag, right? So there was a faster than expected rebound in the economy that has really led to driving these markets higher, right? So in July, the Labor Department reported employers added almost 5 million jobs in June. Another 3.1 were added over the next 2 months. And weekly jobless claims have kind of continued to step down, but while some industries or some sectors like manufacturing are starting to signal strong returns, you're still seeing weakness in the service sector, restaurants, airlines, hospitality, et cetera, as there's still ongoing struggle with the coronavirus. What that looks like on a go-forward basis is still, let's say, cautiously optimistic, but certainly over the near term, the expectation is the service sector is still going to struggle, and that one should expect unemployment's going to remain at about the pace it is right now. Certainly not, and just a kind of point to remember, if we went back to February, unemployment was at a historic low. Not that 8% unemployment, which is about where we're at nationally now, is great, but historical norm is about 6%. So certainly, unemployment is not where anyone wants it to be, and the expectation is certain sectors are going to continue to struggle over the near term, say the next 12 to 18 months.
So, James, we've seen a lot of interventions at the federal level. Tell us a little bit about what policymakers have done to continue to support the economy and financial conditions.
Well, there have been several tranches of federal stimulus and really in a fashion that has never been seen before when we talk about dollar figures, raw dollar figures, trillions of dollars here, hundreds of billions of dollars there. I think just kind of bottom line up front, everyone, most economists that we speak with, most analysts that we speak with have an expectation additional stimulus dollars are going to be required to maintain momentum. What those dollars really provided was something that we did not have, let's say in 08 and 09. So in 08 and 09, as the market started to fall apart and the economy started to fall apart, there was an acceleration downward. We didn't get that here, and that's a good thing, right? So all of the stimulus money that's been put into play really helped to stamp out that downward deceleration where the market would continue to fall, the economy would continue to fall. Some interesting moves. I mean, we are definitely seeing all of the tools come out of the toolbox. If you think of central banks, the Federal Reserve, for instance, and this is probably not something the average investor picked up on, but the Federal Reserve has kind of changed their language around their inflation target. So traditionally, they've had a kind of a fixed number where they said, hey, if inflation gets above this number, we're going to take certain corrective action. And what they've changed to is more of like a rolling average. They're saying, as long as inflation stays on average below a certain number, then we're not going to do anything. Well, because inflation has been running so low for so long, they're really going to let inflation run a little bit, and that's a good thing right now. Kind of the short version of the answer is most economists don't think that fiscal austerity or tighter monetary policies are anywhere in the near future. Most are saying several years away. So the expectation is not a lot of belt tightening in the near term, and some additional stimulus dollars are probably coming.
That's great to hear. Certainly. So one of the factors fueling third quarter performance has certainly been speculation over the election. I don't want you to have to, read a crystal ball or anything like that, but from a historical context, how have markets performed in the short term around elections?
It's really the overarching question that everyone has. And we were able to speak with several political strategists from different firms. These are folks that study elections and election cycles, that worked inside of the machine, if you will. The kind of short answer is that who wins the presidency or what political party is in power has had historically little effect on the market. When we look at market returns, US equity returns, or even global equity returns, 1 and 3 years post-election, what we find is it's wildly positive. So whether you have a Democratic president, a Republican president, a Democratic House, mixed between different branches of government and different parties, there are minor variances as far as average returns, but they're all so close that it's almost indistinguishable. What we do try to remind people when we think about elections is elections are notoriously peppered with kind of angst and speculation and anticipation, but we have to think about this as an investor, not as necessarily even a concerned citizen. And just remember a couple of key points about elections. Things are not always what they appear, right? Politicians make promises and proposals on the campaign trail that don't ever make it to the light of day. They never make it through the lobbying process or the political process. So politics has its impact, but it's not the way that we think. This is maybe the most important point, which is most of these popular scenarios, for instance, there's speculation if one candidate wins, then certain sectors of the economy are going to do better, right? If somebody is seen as a clean energy candidate, that green energy companies are going to do better, just as a hypothetical. The reality is most of these are priced in, right? I mean, markets are very efficient. So there's really not and you hate to say it this way, there's really not a play on the election because all of these popular scenarios are priced in to all of these underlying securities. And like I said on the front end, politics have very little long-term market impact. So just especially as we get close, we're in the last week prior to election, we would just caution everybody to kind of maintain composure and realize, again, from an election standpoint, what we normally see has played out in an amplified fashion this year, which is a lot of cash on the sidelines. These are at the institutional level, pension funds, sovereign wealth funds. At some point in time, those dollars, once the election gets some clarity to it, those dollars are going to be put back into play. And again, that's accretive to people that are already invested.
Well, James, that's certainly great to hear, especially given that this may be one of the more contested elections, certainly of my lifetime, and one because of, COVID, we might not even know the result on, election night. So I think it's good to hear that even despite those extenuating circumstances, if history plays out the way it has, in the past, that shouldn't necessarily negatively impact our returns in the long term. I do want to, just kind of quickly ask for your thoughts because a lot of this really gets to the whole heart of emotional, investing, and certainly part of what we do here with the foundation is to take a long-term approach. So why is it important for individuals to focus on the long term and their goals? And then maybe if you could share an example of how emotional trading can sometimes impact long-term performance.
Well, I mean, there are countless anecdotes about how emotional investing is just detrimental. But very simply, there are large-scale studies, and I'll give you an example. There are large-scale studies that look at equity mutual funds, U.S. equity mutual funds, and they look at the returns of those mutual funds, and they can compare those versus actual investor experience, right? So the average return over the last several decades of U.S. equity mutual funds is about 10%, which is pretty good. The average return for the investor that is invested in those funds is about 4.8%. Why is that? Because most investors tend to base their decisions on emotion. They get out when things feel rocky. They get in when things feel great. And so they're buying high and selling low, which is anyone that's ever read any investing book ever knows is the exact opposite that you're supposed to do. I mean, what we know is no one knows when the best days are going to be. And just to give an example, on a day-to-day basis, if you take the entire year and you look back over a whole bunch of years, 10 years, 20 years, 50 years, on average, US equity markets are up positive for the day about 53% of the time, and they're down about 47% of the time. So pretty razor thin edge, right? Like coin flip. You wouldn't really know whether tomorrow is going to be an up day or a down day. But what we know on an annual basis is that US equity markets are up about 76% of the time. So skewed, and that's only on 1 year, right? That gets a much wider spread when you start looking at 3 years and 5 years and 10-year time periods. So the takeaway is nobody knows what's going to happen tomorrow. Nobody knows what's going to happen 3 days from now. It's basically a coin flip. Is the market going to be up? Is the market going to be down? But what we do know is that over long periods of time, the market goes up. Over intermediate periods of time, the market goes up. And we also know how corrosive it is to miss the best days, right? There's multiple studies done, and we have one that we looked at recently because we get this question not infrequently, especially around periods of high volatility. And you can look back over the last 20 years, and if you miss the best 10 days in the last 20 years, the best 10 days, your returns are about 30% less, right? So if your average return is 9 point whatever percent per year, if you miss the best 10 days, that number goes down to 6 point something percent. So 10 days is not a lot when you talk about 2 decades. So the moral of the story is you have to stay invested. You have to be invested. You have to realize that, especially for foundations and endowments where you have to continue to grow, you have to continue to outpace inflation. There's just no other way to do it. It's kind of, unfortunately, the volatility is part of the ride.
Well, thanks for that, James. Just as a quick announcement, I did want to mention to our fund holders, one of the things that we've been working on here at the foundation is making some changes to our investment policy. And the board actually met about a week ago and approved a brand new investment policy for the foundation. And one of the things that's included in that, and I find this very exciting, is we're increasing the number of fund portfolios that we're making available to our donors to be able to choose from. So in the past, you were in one fund and it had an asset allocation and you were along for the ride one way or the other. So now one of the things we're allowing donors to do is to choose based upon their own interest and maybe even their gift timeframes, pools that have different asset allocations as part of those. So that's going to be exciting and something I look forward to sharing a little bit more with you about. In the meantime, if you have any questions, certainly feel free to reach out to myself. If I don't know the answer, I'll definitely connect you with one of our resources like James or one of the other financial advisors that we utilize here at the foundation. Thanks so much. Hope you have a great day.